Good morning, everybody. We're going to give it about 30 seconds here to make sure everyone has a chance to log on. Then we'll get started with our presentation. So stand by. All right, everybody, we're going to give it about another 30 seconds and we'll get started here. So hold on. All right, we'll get going here. Welcome everyone to our election year estate tax planning strategy call. My name is Scott Duba. I'm with Prime Capital. I'm joined by a wonderful team of professionals, including our partners at Spencer Fane that are helping us put on this hopefully very informative call. We're going to have a lot to cover today, which hopefully you'll find informative. For those of you that don't know me, I'm the Chief Investment Officer at Prime Capital and the Managing Director of Wealth Management. Just a quick recap on who we are, in case you're not familiar, because we've grown a lot over the past few years. But Prime Capital is a national wealth management and advisory firm. We serve both the wealth management channel, the retirement plan channel, and the institutional channel. As of year end, we had about 15,000 households, 800 or so retirement plans, about 25 billion of AUM, and we're active in 48 states across 176 of what we think are the best wealth advisors in the country. We're going to be joined by several key partner firms that we do a lot of work with. One of those is Aperio, which is a unit of BlackRock. We have Ellen Reynolds and Matt Johnson of Aperio, which are going to help explain how Aperio's direct indexing solution can be used in client portfolios to mitigate taxes. We're also going to be joined later by Mera Pandit of JP Morgan Asset Management. She's an executive director and global market strategist, and she has been kind enough to give us her time to talk about the election year and how JP Morgan views election year investing and what to expect as the year plays out. But before we get into that, I'm going to turn it over in a second to our partners at Spencer Fane. We're lucky enough to have 3 individuals from Spencer Fane. Mindy Ward, who specializes in estate planning, Kelly Mooney, who's a tax expert, and Pete Hartwiger, who's a key partner advisor to Prime Capital on the corporate side. Pete, I might turn it over to you for a second to maybe give us a quick recap for those that might not be familiar with Spencer Fane, who you guys are and what type of industry verticals y'all serve.
Great, thanks, Scott. As Scott said, I'm Pete Hartwiger. I'm a partner with Spencer Fane in our Kansas City, Missouri office. We are a national full-service law firm. We have over 470 attorneys. We are based in Kansas City, Missouri. We have over 23 offices now. We're in Houston, Dallas, Minneapolis, Kansas City, Phoenix, Las Vegas. We're all over now. We combined with a Utah firm that's going to be official here in a couple months, and that'll put us over 500 attorneys. As I said, we're full service. We pretty much cover everything, and no specific one focus. We tax, estate planning, corporate mergers and acquisitions, litigation, all the good stuff. We were in the summer of 2023. We were named the fastest growing law firm in the country. The top 200 firms, which is over the past 5 years, we were the fastest growing firm. When I joined 14 years ago, we had 90 attorneys. Now we're over 500. We're kind of like on that trajectory with Prime Capital. I mean, just growing. greatly. We actually, ironically, we're in the same, our Kansas, Overland Park, Kansas office is in the same office as Prime. They're a floor above us, and they have a lot larger marquee on the building. We're kind of over to the side. They're right there, big one in the middle. So they give me credit about that. We were nominated as one of the 8 finalists of National Law Firm of the Year this year, and so we didn't get it, but we were in the top 8. So as Scott said, today we have Kelly Mooney of our Phoenix office who's going to talk about tax, and we have Mindy Ward of our Overland Park, Kansas office who's going to talk about estate planning. So obviously we got a lot to cover, Scott. So back to you.
Thank you, Pete. Appreciate it. So Kelly, maybe we'll start off in your court. Federal tax policy, a key concern, I think, of everybody as we head into an election year. You know, a lot of our clients, a lot of our individuals that we work with, there's a lot of entrepreneurs, a lot of business owners, a lot of people that have worked very hard to build up their family's net worth and are looking to protect that and, you know, be smart about knowing what's on the horizon. I'll turn it over to you, and maybe if you could just give us a sense of kind of what you're talking about with your clients in terms of potential changes in tax policy as we head into this election year.
Yeah, absolutely, and thank you, Scott. So I think if you want to flip to the next slide, with the uncertainty of the upcoming election and the fact that Congress is fairly divided at the moment, I'm not expecting to see any meaningful tax legislation in 2024. With the exception of the Tax Relief for American Families and Workers Act, which is currently pending in front of the Senate. It's been passed by the House. But what I'm really watching for, and I think the elephant in the room, is whether the Tax Cuts and Jobs Act, very favorable business and individual tax provisions and rates, will be extended beyond 2025. Currently, it is set to sunset at the end of next year. I think the answer to that will depend on who wins the election and or gains control of Congress. But that's really what I'm watching for. And if I'm talking with clients, I'm talking about the fact that we're in a very rate favorable environment at the moment. Tax rates may be going up depending on the election results. So now is not necessarily a bad time to sell a business or dispose of other assets. So next slide. And as I had just mentioned, one piece of tax legislation that is currently pending is the Tax Relief for American Families and Workers Act. And this is really, again, getting at some of the provisions of the TCJA that are set to expire. This bill would extend those at least into 2026 for some of these provisions. Some of the key items here for businesses are the immediate ability to expense research and development costs. That actually expired at the end of 2022. This would extend the ability to take a deduction as opposed to having to amortize those amounts. This would also extend 100% bonus depreciation through the end of 2025, and it increases the Section 179 expensing deduction, and all of those are very valuable deductions for business clients. Next slide. As I'd mentioned, this bill is currently pending in front of the Senate. It was passed fairly unanimously by the House. The Senate's currently on recess, so we won't know until perhaps the end of this month at the earliest. One caveat is that if this act is passed, Congress intends to pay for it through increased enforcement and penalties on fraudulent or erroneous employee retention tax credit claims. There's a lot of audit activity around those at the moment. So for businesses that claimed that particular tax credit, we're seeing a lot of enforcement activity. Next slide. Other than that, as I had mentioned earlier, I think the really big federal tax policy issue is whether we will see the TCJA either sunset or be extended. One of the issues that the government is facing is the budget deficit increases. The TCJA came at a $3 trillion cost to the government. But however, as I mentioned, it is incredibly favorable. Right now, the highest corporate tax rate is 21%. The highest individual income tax rate federally is 37%. We also have a 20% qualified business income deduction for pass-through entities. All of those may sunset at the end of 2025 without congressional action. Next slide. So again, that's really what I'm watching for. I think whether we see legislation or not will depend not only on the election outcome, but also on what budget deficits look like coming into next year.
I may have neglected to mention this, but I believe participants do have the ability to ask questions via chat. If I'm correct, and you do have the ability to do that, go ahead and drop some questions in chat, and I'll try to get to them by the end. But maybe I'll ask a question. So with respect to the TCJA, I guess first question is, it would seem that the federal government, or rather the leaders, has gotten more sanguine about budget deficits over the past 5 years. Do you feel like leadership in the House, the Senate, even the White House, is there any sort of sense of responsibility coming back in terms of worrying about deficits, or are we still kind of on this kick the can trajectory? Or do you think that over the next few years there's going to be more of a commitment to trying to mitigate what seems to be ever expanding deficits and ever declining net tax revenue?
And that's a really hard one to answer. I think at the moment we are in more of an environment that suggests we'll let the deficits grow in favor of keeping tax rates low, which is of course favorable to our clients, but that could change at any moment. So that's a little bit hard to predict, but if I had to guess at the moment, I think we're leaning more towards the latter of, letting those deficits grow.
Right. Typical Washington, wait and see, right? Okay, well, thank you for that overview. That was super helpful. I'm not seeing any other questions, which means either there aren't any yet or my technology is not working. But we'll move along to kind of the next section here. So Mindy, maybe kind of moving over to your part of the world. Look, tax policy is always a little bit murky in terms of predicting what may or may not happen depending on election cycles. But maybe you could weigh in here. Again, a lot of our clientele are entrepreneurs and business owners, and most have some sort of legacy assets that they're going to be passing on to heirs. What are the conversations? What are the topics that you're having with clients as we head into this election year?
Most of it is I am not a very good gambler, so I really can't guess one way or the other. Where we're at now is alluding to what Kelly was talking about. Most of the estate tax that we're discussing has to do with the TCJA. In 2017, when this was passed, the estate tax credit, or that coupon that you get, was $5 million, subject to inflation. And under this act, they increased it, they doubled it. But obviously that's set, that is going to sunset in January of 2026. That's a pretty significant swing, especially for married couples. So that there is a lot of conversation about what can we do to take advantage of the higher credit now before we lose it, if we're going to lose it. Unfortunately, for people in a certain space, it becomes a very complicated planning question, because some of the planning that we're doing is irrevocably giving things away and losing control. and not everybody wants to do that. So do you really, really want to give up control and give up the asset in order to save tax?
Do you view this, is it somewhat of a, I mean, what's the downside to acting early? Is it just the control dynamic? I mean, if it's, hypothetically, there's an adverse outcome on this provision and the exemption decreases by half, that'd be bad, right? Because people have missed the window to move assets in a tax efficient way. It seems like there's good reasons to just do it and get it done with. What would be the downside? Is it just simply that loss of control?
You really have to be careful because I have a lot of clients who come in saying, I heard on the golf course that my buddy is doing this and I think I should be doing it too. It's very specific to the types of assets that you have, what your family dynamic looks like, and what kind of control you want to maintain. There are a lot of options, but there's a lot of complications. Back to your question, a lot of clients look to me and say, is it going to go down? Do I really need to do anything? I've been doing this for 25 years, and in the history of estate tax, we've never seen the credit go down ever. We've seen it stagnate. We've seen no estate tax for a year, but we've never seen it go down. So part of me says, oh, they're just going to kick the can down the road a little longer. They'll extend it for a couple more years. It's all very contingent on who wins the election and what that political shift looks like. But then at the same time, this is a sunset provision. So in order for anything to happen, and in order for it to not go down, they actually have to take some kind of affirmative step. And my confidence in their ability to consent or come to some kind of agreement dwindles with each passing year. We just don't see that they have the ability to come together and agree to anything. But then I feel like I'm playing pickleball. On the flip side, when you bat to the other side of the court, most of the people who are making these decisions are impacted by this law. So they have personal reason to want to extend the credit threshold. So most of those senators have taxable estates. If they do cut it in half and allow it to sunset, it's going to be taxed out of their back pocket. So they have some skin in the game. So it really is, I really can't predict one way or the other. It's largely dependent on what the election looks like. And I suspect nothing will happen this year. They can't act. No one can act quick enough this year to make it work, I would think. We would probably see some action next year, if anything.
Okay. That makes sense. I got you a little bit off track here.
Very good.
Is the TCJA kind of the main thing we're
Yeah.
watching, or are there other sort of key points that we should be considering?
And that's the big one. The Corporate Transparency Act kind of threw a wrench in things. That has a lot to do with the IRS. They hired a lot of, I'm sure you all heard, they made a massive hiring a couple of years ago. A lot of those people are data analysts. They're looking at information that's going to be plugged into this database through the Corporate Transparency Act. So the IRS is a little distracted on that legislation. We all kind of are. So it'll be interesting to see how implementation of the Corporate Transparency Act takes place over the course of the year. But yes, it is largely, a majority of my conversations are, is the estate tax credit going to go down?
What would be the implementation, or what would be the implications of that Corporate Transparency Act?
It's largely just a distraction. The IRS is focusing on the information that's going into that and successful implementation of that, because they are an arm of this, of the implementation of that. It's designed to catch tax fraud and money laundering, and so the IRS is involved in that. So there is a lot of attention being directed toward that. So it could be a little bit of a distraction.
Okay. Any other sort of key points to hit on estate and tax, or is it more just
Well,
kind of waiting to see how the exemption
one
rolls
thing I
forward?
do want to point out is you definitely don't want to do anything prematurely. If you're going to make a large gift, I tell clients, don't let tax wag the dog. I've been doing this for, like I said, 25 years, and there has yet to be a year where the estate tax stayed the same. So depending on how old you are, what the nature of assets that you have, sometimes just waiting is an okay tactic.
Yeah.
But to be clear, if you are going to take advantage of the higher estate tax credit, it's an all or nothing scenario. You can't make a smaller gift. You can't say, well, I'll give half now, because from a calculation standpoint, you're not gaining anything. Because if you give a $7 million gift saying, I'll take advantage of half of it, and then the estate tax credit drops, it's going to drop to about 7 million. So you really have left money on the table. So if you're going to take advantage of this, you have to go all in. So you got to give the full 14 million or 13 million or whatever happens to be. And the other thing I always caution people is there is quite a bit of activity around the discounting. A lot of clients, especially entrepreneurial clients, have the ability to discount values on property that they're giving for minority interest and lack of marketability, and the IRS and the courts are scrutinizing that quite a bit. So you have to make sure you're playing by all of the rules when you make those gifts in order to make it to get the maximum impact.
Sure. Well, and to state kind of something that's probably obvious. I mean, these are complex, individual, specific decisions,
They
and
really
I think
are.
that's why. Well, and it's why I think it takes a team. Your wealth advisor, the investment team, the legal and tax experts to make an informed decision. Because that's why
Absolutely.
it's kind of the spirit of this call is, we work well with Spencer Fane because we can sort of opine on the investment portions of it and the wealth plan, what you're trying to do long term, but then we bring you all in to help make an informed decision for each client specific case on what the right roadmap is. So
That's right. And the one very important factor that comes up regularly, I have a lot of clients coming and saying they want to do this, but when I explain to them the irrevocability of the transfer and their ability to control assets that they have irrevocably given away, sometimes the desire to do those kinds of tax saving techniques dwindles a little bit, because most people who this change in the law impacts have control. I don't want to say control issues. They largely got where they're at because they've maintained a great deal of control over what they have. And so the idea of giving up control over assets gives them a little bit of pause. But our key go-to still is leveraging insurance. I mean, life insurance is an easy solution. I am a keep it simple, stupid person. If we can do something that's easy, you don't have to do a lot of work maintaining. Insurance is a very easy way to accomplish sometimes avoiding the problem, which is estate tax.
yeah, that makes a lot of sense. And we have, if any of the clients are interested in that, we've got some very intelligent insurance experts on staff, so we can obviously get with Spencer Fane and go through many of those options in detail. Maybe what we'll do now is, and thank you, Mindy, that was super helpful. I might come back to you with a couple other questions that arise as we go. Maybe right now I'll move it over to Ellen and Matt to talk a little bit about Aperio. Ellen, Matt, it's not always about election year potential changes to tax policy. Maybe you guys can walk us through how Aperio's direct indexing strategy can be more of a permanent portfolio allocation to help generate some tax alpha.
Yeah, absolutely. And thanks, Scott. Thanks for having us on today. So for tax mitigation considerations and tax management with your portfolios, Aperio can be a really good option. So my colleague Matt Johnson and I will talk through direct indexing and how it can help investors. So first of all, what is direct indexing? So if you could go to the next slide, Scott. Perfect. So direct indexing is a strategy that seeks to replicate the returns of an index. So let's say the S&P 500, which is all US large cap, on a pre-tax basis, while seeking to add value through systematic tax loss harvesting, which is where we get the tax alpha piece. So how do we do this? How is this accomplished? It is accomplished through the direct ownership of the individual stocks that are held in the separately managed account, which we shorten to SMA. So you'll hear Matt and I use the term SMA in the next 10, 15 minutes. On the Apereo team, we manage about 80 billion in AUM, just to give you a sense for what we do in the business. We manage over 17,000 SMAs. So we've been doing this a long time, since 1999, have over 2 decades of expertise, and we only build, manage, and optimize these SMAs. This is our core focus. So direct indexing within these SMAs puts you, the investor, at the center of the portfolio, which allows you to address individual tax needs. And we do this, again, through that systematic tax loss harvesting, which Matt will dig into here in a minute. A few other components of SMAs and the value proposition to maybe using this vehicle beyond tax mitigation and tax management are really 2 things. You can reflect personal values. So Apereo is completely agnostic and this is optional, but if you wanted to incorporate a faith-based strategy, or we see this with some newer generations with families that we work with, they might want to do something that's socially responsible, you can personalize around those values and be able to really customize. You can also personalize these SMA portfolios beyond just the tax piece. You can personalize around investment preferences. So if you're working with your prime capital advisor and you want to increase the dividend, you can do a dividend yield strategy. There's a lot of different ways you can customize. So many of you on this webinar are probably really familiar with ETFs, but you might be less familiar with SMAs and the benefits. So I want to spend just a minute explaining and comparing the 2 different vehicles. So with ETFs, they provide really good diversification. They can be low cost. They can also be tax efficient. So they can be good products for a lot of different investors. A lot of you probably use ETFs. On the other hand, with SMAs, they can also provide diversification. They're low cost, more tax efficient, given Apereo can harvest losses at the individual stock level. And we do this in a really systematic way. You can also personalize, like I talked about a minute ago, since you directly own those stocks within the SMAs. And it's not a wrapper like an ETF. You own those individual stocks within the SMA portfolio. The other piece that's really helpful with an SMA is you can transfer securities in kind. So I like to always highlight this when investors are considering an SMA for the tax efficiency components. So let's say you have 20 or 30 stocks that you've been managing maybe by yourself or maybe with a different advisor, and you're looking to consider an ETF or an SMA. If you were to use an ETF, you would need to fully liquidate 20 or 30 of those stocks, pay probably a pretty big price tag in terms of taxes, and then invest into the ETF. With an SMA, we can take those securities in kind and transition those 20 or 30 stocks within the Apereo SMA portfolio, and you don't have that huge tax hit. So it can be really tax efficient when you're thinking about legacy securities and bringing those over in kind. So Scott, I'd love to pause there. I thought that was a good overview with this slide, and hand it over to my colleague Matt, and he'll go through a few more slides about the tax loss harvesting component.
Awesome. Matt, I'll flip to the next slide and you can take it away.
Thanks, Scott. Thanks, Ellen. And you know what, Scott, if we could just go to slide 30, I want to highlight the importance of focusing on taxes in our portfolios. You know, at Apereo, one of my roles is a tax economist, and tax economics is usually a term that makes people go to sleep, right? Taxes and economics, your least favorite subjects in college, but that's my job. And basically, tax economics is a framework for maximizing risk-adjusted after-tax returns. And as you think about taxes and the potential for changes in tax policy, a focus on taxes in your portfolio is extremely important. this slide that we have in front of us shows us just how big of an impact taxes can have on one's portfolio. If you look at the this portfolio over a 20-year period, if we assume a 7.5% return, going from the red section in the slide all the way down to pink, this shows that the difference in your portfolio is, when factoring in tax drag, is over $600,000, right? If you have no tax drag, it's a little over $2 million at the end of your horizon versus 1.5 million with a 2% tax drag. And that's very real because many investors have capital gains distributions and capital gains from different types of strategies in their portfolios. And so how does Aperio fit into that? Well, we are, as Ellen said, a systematic tax loss harvesting manager. The goal of our strategy is to provide you that index exposure at the core of your portfolio so that you can then offset gains elsewhere in your portfolio and reduce that tax drag. So whether that's capital gains from rebalancing a model, or capital gains from an active manager, or perhaps an alternative strategy, these losses are incredibly useful. They're actually useful even if you don't have gains in your portfolio currently. Perhaps you're thinking about selling a business, or you may have some real estate transaction that's scheduled to occur in the future. You can use these losses as a bank against which you can use to offset gains in the future. Losses do carry forward. They expire at death, but you have the ability to use them in the future. And that's what's so valuable in these strategies. Scott, if we go to slide 33, this is just a very quick example of what happens in our portfolio. So when we build a portfolio at Aperio, you're going to own many securities. Just instead of owning one security in an ETF, you're going to own all of the underlying holdings. And the goal in that portfolio is to harvest losses from the names in the portfolio that have gone down over time, while still tracking that index. And oftentimes we get the question of how's that possible? Well, the biggest names in market cap weighted indexes or cap weighted indexes are the familiar names, the Apples of the world, and they drive a lot of the return. But in every year, there are some names that are held at a loss, names that depreciate in value. So when we at Aperio manage these portfolios, we go through and we're monitoring every account daily. So as Ellen said, we have over 17,000 accounts. We have a team of portfolio managers that every day we're looking at every account, monitoring for buildup of cash, for buildup of losses. And if we can realize losses, we want to bank those so that you can use those to offset gains elsewhere. And so on this slide, you see, in stock ABC, it went up in value. We're going to hold on to that, right? We want to defer that gain. But the stock XYZ, it's gone down in value. So when we see that, we want to harvest that loss so that you can use it. Maybe you use that loss to offset ABC if you want to sell that. Maybe you use some of that loss to offset ordinary income on your return, limited at $3,000. And then if you have any excess losses, they carry forward into the future. It can be very simple when you think about it in this context. Scott, if we'll go to slide 34, the taking away, zooming back out to what we do at Aperio, tax efficiency is but one leg of our portfolio management. We want to reflect the personalization in the portfolio. So reflecting the exposure that you're looking for, you see the holdings that you own, so you know what you own in your portfolio. You see the types of activity that we're transacting every day. You have a sense of what's happening, and we're doing this in a tax efficient wrapper that's super flexible and can be used to incorporate holdings from outside. If you have other managers that you're looking to blend into, say, an S&P 500 mandate, for example, this is incredibly helpful for things like concentrated stock positions, right? We can help build capital gains budgets and do very flexible transitions over time. The tool is ultimately about flexibility and giving you an opportunity to tailor your portfolio and to accomplish exactly the types of things that you want to do in a pre-tax world, but maximizing your return after taxes.
Matt, can you maybe just give a generic example? If I were to fund one of these accounts with, let's just use a round number, $1 million, what's the typical experience? I know it depends a lot on market volatility, but in years, say 1, 2, 3, 4, 5, what do you all typically see in terms of losses that you can generate while still tracking a benchmark in those first, call it 3 to 5 years?
Scott, that's a great question. I think that for a cash funded portfolio in the first 5 years, we generally see a 30, somewhere between a third to 40% of that portfolio's starting market value, we're able to harvest losses. So think about year one. Generally, across market environments, if you fund that $1 million portfolio, we're going to be able to realize somewhere on the order of about $100,000 in losses in year one, while still following the index that we're tracking. So if it's the S&P 500, we're going to be able to track the index on a pre-tax basis and still give you in that $1 million portfolio about $100,000 in losses. And that's from actual Aperio data. We've been managing portfolios, as Ellen said, back to 1999, and that's the client experience that we've seen through time. Does that answer your question, Scott?
Yeah, and I think you alluded to this before, but I think it's one of the most interesting ways to use this. If someone is going to monetize a business or have a very large taxable gain event on the horizon, like let's say I'm doing my estate planning with Mindy, and I've decided I want to monetize my business in 5 years. I mean, you can use this to start building up somewhat of a bank of losses in advance of that large kind of unavoidable capital gain event. Isn't that right?
That's absolutely right. Yeah, unlike corporate entities, the losses carry forward indefinitely, expiring at death for individuals. So they carry forward on Schedule D, and in the event that you are expecting some event in the future, if you have cash that you're able to put into an Aperio tax loss harvesting strategy, we can start harvesting losses in advance of that expected event. And when that happens, you'll have this bank of losses to help offset taxes that would otherwise be payable from the transaction.
Awesome. Well, Matt, I want to leave time for our last speaker, Mera from JP Morgan. I think we've gotten a pretty good handle on direct indexing. Any final comments you want to make before we hand it over to Mera?
No, Scott, we appreciate the time. We think it's a really valuable tool, and we'd be happy to answer any questions or dig in further with, as things come up.
All right, thank you, Matt. I guess then we'll move into our last section here, which is kind of the meat of kind of 2024, which is the election. Mera is on the line. Mera, are you there?
I am. Thank you for having me. Good morning.
Well, wonderful. Thank you for joining us. I guess I'll just turn it over to you. I'll run the slides, but we'd love to hear kind of what conversations you're having with clients, how y'all are thinking about positioning for or thinking about the upcoming elections.
Thank you. I think that for us, the most important thing is elections are such an emotional topic. The temperatures are high. So what we look to do is bring down the temperature in the room a little bit by backing up what we think with data and facts, and really stressing the point that ultimately elections are not a huge swing factor for the economy and markets. So what I want to go through in this presentation today is, one, the 2024 election landscape, what's at stake, what's up for grabs. Two, potential policy implications. It's still early in the campaign cycle, so we don't know all of the different policy items that could be up under each candidate, but we do know a couple of things for sure. And ultimately, it is policy, not the politics, that does drive the economy and markets in the long run. And then finally, just thinking about, from prior experience, how to navigate an election year in portfolios. So we'll end off with a section on investing in an election year. So if we go to the next slide, we have laid out a key timeline of election dates, and election season has already started with a couple of the early primaries and caucuses. Now, the biggest day of election season, at least from a primaries standpoint, is March 5th, which is Super Tuesday, because the most number of delegates are awarded to a given candidate. And usually by Super Tuesday, we have a pretty good idea of who the leading candidates are. Now, this year, the whole campaign season in this winter into spring is a little bit less heightened because we have a pretty good idea of who those two leading candidates will be on each side. So that's why you're just getting a little bit less election news overall, because it's somewhat of a foregone conclusion. Nonetheless, we go through the rest of that primary season through June, and then we have the Republican and Democratic national conventions in the summer, where we see the official nomination of each candidate's party. You generally hear about the vice president, and you'll also get some more meat around the policy agenda. And then throughout the back half of the year, it is on the campaign trail, shaking hands, kissing babies, all of that, vice presidential and presidential debates, all culminating in the election on November 5th of this year. So that is the timeline. If we take a look at the next slide, as I had mentioned in terms of the leading candidates here, I think we all kind of have a pretty good idea of this at this point, that the Republican field has essentially narrowed since the beginning of the year to just former President Trump and Nikki Haley. It is looking like President Trump is very handily leading in the polls. And on the Democratic side, President Joe Biden is going to rerun, so no major contender emerging there. So some people are joking that this is the unpopularity contest that nobody has wanted to see on both sides, regardless of where you fall politically, with a potential Trump-Biden rematch. And as of now, former President Trump is polling ahead of President Biden. It is a long year ahead of us, so we will continue to see how this fluctuates, and in particular, where this shakes out in some of the key battleground states as we get into the fall. But it's not just about the presidency, it's also about Congress. So if we move to the next slide, in terms of the landscape of what is at stake this time around, what we've tried to show here is the votes and seats in the Electoral College, the Senate, and the House of Representatives, and who is controlling both, and what it would take for a flip to the other side. So if you start off with the Electoral College, there are 538 votes, 270 to win, and last time Republicans got 232 votes, so they would need to pick up 38 Electoral College votes to win, which is a slimmer margin than you think for reasons I will discuss shortly. If you look at the Senate, there are currently 49 Republican senators. They would need to pick up 2 seats there in order to take the majority, or perhaps just 1 if they also win the White House, because the vice president casts the tie-breaking vote. And then finally, in the House, we actually have a slight update to this given the special election that took place this week. But if Democrats wanted to flip the House in their favor, they would need to pick up about 4 seats in order to take majority there, as all 435 seats are up for election. So diving into this, yes.
Quick question. This is this data is as of the end of the year. Has this changed much in January and early Feb as maybe Trump has emerged as the front runner, or is this still pretty accurate in terms of where things are trending?
So this isn't necessarily where things are trending. This is what the current makeup of Congress is now, and what a given party would need to flip in order to take control. So no subjective ideas here. It's simply just what's at stake. And the only thing that's changed is in the House that has narrowed a little bit because we had a special election for Representative George Santos' seat.
Got it. Okay.
But if we think about, weighing some of this more specifically on the next slide, from an Electoral College perspective, we look at the map of the Electoral College back from 2020. And again, Republicans had picked up 232 votes relative to Democrats 306. So if we think about that 38 vote spread, it's actually a lot less than you think, because if you look at that bottom box there where we look at the tightest races of 2020, between Georgia, Arizona, and Wisconsin, they had 37 Electoral College votes, but were decided by just 43,000 votes. So a very slim margin there. So essentially, these are the states in that bottom box there. Add Pennsylvania, North Carolina, Nevada, Michigan. Those are the states that are likely going to determine the presidency, and the ones, therefore, we'll be watching the closest on election night that tend to be very close races. On the next slide, in terms of the Senate, there are, of the 100 Senate seats, about a third up for election every 2 years. This time, 34 seats up for election. The 11 that Republicans currently hold are pretty safe seats, whereas the 23 that the Democrats hold have some weak spots. So all the toss-ups are ones that are currently Democratic seats. And West Virginia, which Senator Joe Manchin is no longer running, is very likely to flip into Republican control. So the House, or excuse me, the Senate is looking a bit risky for Democrats, given that a lot of the most vulnerable seats are the ones that they have, and it is such a tight split there in terms of turning over control. And then last but not least, on the next slide, in the House, what we show here is the seats that have flipped in one direction or the other based on, you can see the colors there, lost and gained in all the different House elections since 2008. All of the House seats are up for election. And really at this point, it's just a 4-seat flip that Democrats would potentially have to pull off in order to take back control of the House. So to your earlier question, we don't have necessarily a House view yet in terms of how things will shake out, since it's still pretty early. But this is at least what's up for grabs and how close a lot of this will be. So if we take a look at the next section here on policy, it's not necessarily the election process itself, but the outcome. Who wins, and what does Congress look like, and how much of their agenda can they get done? And we're going to start to hear a lot from both of the candidates about what their various policy agendas are and what they are looking to accomplish. But to the theme of today's webinar, taxes, there is really only one thing that must get done during the next presidency, which is a decision on the 2017 Tax Cuts and Jobs Act. Now, I didn't hear all of the prior comments earlier, so some of this might have been covered. But essentially, if you look at the Tax Cut and Jobs Act, there are some permanent provisions, and then there are some temporary provisions. So on the permanent side was that cut in the corporate tax rate from 35% to 21%. So when we think about earnings, the impact from this perspective could be somewhat limited, because we don't necessarily expect, unless there's some active decision made, for there to be a change in the corporate tax rate. It's not going to automatically revert back to what it was before this act was passed. However, those provisions will apply to estate exemptions, as was discussed before, and also the individual tax rate. Now, the challenge here is that, at the end of 2025, these rates sunset and potentially go back higher. So the political conundrum here is basically the $2.6 trillion problem. Either those tax cuts sunset and taxes go up, and therefore you see the taxpayer on the hook for another $2.6 trillion, or you extend those tax cuts, and then all of a sudden you have $2.6 trillion added to the deficit. And of course, there is a middle ground in which some areas get extended and others don't. So there's permutations in between for sure. But the challenge is, if you look at the top right here, when we consider our federal finances, we are currently looking at deficits, 5 to 7% going forward in the future for the next 10 years. This compares to about 3% budget deficits as a share of GDP on average over the last 50 or so years. So the challenge here is the deficit is already looking very high. If you add to that deficit, that would be 6 to 8% over the next decade or so. So we're going to have some challenges when it comes to federal finances, because you can see our debt to GDP continuing to grow, our borrowing exceeding $1 trillion a year. And the challenge here is that in the long run, we either need to see higher taxes, less spending, or both. And they tend to be politically untenable. So there will need to be some decisions made specifically around this topic during the next administration, kind of no matter what. Now, we're going to add to this policy section as the year goes on and we get some more proposals from both sides. But again, this was the hottest topic amongst the policy prescriptions here because of its urgency and what has to happen. But if we think beyond policy and we think about markets and portfolios in election years in the next section, what we tend to see is that elections don't have a huge impact on portfolios. They, of course, have a huge impact on politics in the long run. People are entitled to their political opinions and should absolutely express them, but in the polls, not in a portfolio. And so our cardinal rule of investing during an election year is don't let how you feel about politics overrule how you think about investing. So this slide here shows the share of Democrats and Republicans who have favorable views on the economy. And what you can see here pretty clearly is that Republicans feel better under Republican presidencies and Democrats feel better under Democratic presidencies. Now, the challenge here is that we obviously invest based on our outlooks, and yet that's not necessarily corroborated by investment returns. So what you can see in that top box there as we look at returns on an annualized basis of during different administrations, and returns during the Trump and Obama administrations were almost identical at around 16% and well above the last 30 years average of about 10%. So if you divested or sat in too much cash or sat on the sidelines too much because you didn't like the guy in the White House, you could have missed out on some above average returns. So if I think about what links those two presidencies, it was really more about the fact that during both of those presidencies, they presided over zero interest rate environments. So essentially, it's really about the macro drivers, not necessarily the political drivers, even under very different regimes. Now, if you take a look at the next slide, nonetheless, we still get tons of questions on what do returns look like under this political configuration, under this year of the presidency, under this permutation. We get hundreds of questions like that. And while those charts are actually reasonably easy to pull together, and we put a few of them on this slide here, if I were going to retitle this page, it would be "These Charts Don't Matter," because they don't really tell you a lot about why a specific outcome happened or whether or not it will be repeated and why, because these are just simple averages. And again, it's really about the economic context that drives markets much more. So I'll give you an example on the next slide. At a very high level, if you look at returns back since the 30s in election years versus non-election years, and if you look at volatility in election and non-election years, returns are worse, volatility is higher. But also consider that in the last 20 or 25 years, we've had some huge episodes of market turmoil during election years, whether it was the tech wreck in 2000, the financial crisis in 2008, or in 2020, the pandemic, which caused a lot of volatility. So we have to consider that economic context because none of those events had anything to do with it being an election year itself. And by the way, we've looked at a lot of different data too, because we get questions on sectors. You assume one party or the other has specific policies, therefore X sectors should do better under Republicans and Y sectors should do better under Democrats. Long-term returns do not point to any consistent investing strategy that suggests that there are sector bets you can make based on which party wins. There's so much that goes into how markets perform, and policy is one piece. We know monetary policy acts with long and variable lags. That is the same with fiscal policy as well, and sometimes it has different and unintended effects. Now, I do want to acknowledge on the next slide that we do see some more volatility in the lead up to an election. So this slide looks at the 100 days before the election and the 100 days after in the S&P 500. And you can see there, back since 1980, after we clear the election, things tend to improve because markets don't like uncertainty. And once we get those results, regardless of the result, we tend to see markets recover. The two exceptions there are 2000 and 2008, which we covered on the prior slide. But essentially, we do start to see markets go back to focusing on the fundamentals. So we get a lot of questions then of saying, like, okay, then I should just invest after the election to bypass this period. But the challenge with market timing during election years, you usually see that pickup in markets very quickly or even before the election's even done. So for example, in 2016, futures selling off heavily during the results coming in, and yet the regular trading day was up more than 1%. So a big turnaround there in sentiment. 2020, we did not have results until the following Saturday. And yet between the end of the day that Tuesday and the end of day Friday, markets were up about 4.2%. And in both cases, you had a pre-election rally in the days leading up to those elections before people had even cast their vote of about 3%. So what we like to say is by the time volatility settles down, markets have already settled up. So you've probably missed your entry point. So in conclusion, on the next slide, last but not least, what we do tend to see over time is under Republicans, under Democrats, under divided government, which is the most popular configuration of government, you tend to see real GDP continue to grow at strong levels, as you can see on the top, and the S&P 500 do pretty well over time, as you can see from the returns there. So it is not about the American president or the American government. It is about American companies and the American economy, which have been pretty resilient and in fact quite robust, regardless of what's going on down in Washington.
That makes sense. So a lot of news, a lot of headlines, but not terribly impactful for the long-term portfolio allocation decisions. Stick with America, right?
That's right. A lot of this ends up just being noise and not having a big impact on longer term portfolios.
Okay. Well, thank you, Mera, for that that overview. That was super helpful. Let me, we've got a couple minutes left. I want to squeeze in a couple quick questions. Mera, we asked one of our Spencer Fain presenters this question earlier, but with respect to the budget deficits, do you see anything on the horizon that could be a catalyst for a little bit more fiscal responsibility, or is everybody just good with kicking the can?
Well, I didn't catch the answer to this from Spencer Fain, but I think from our perspective, I just don't see a lot that can change the situation immediately, because maybe you have a Republican Party that wants to extend some of those tax cuts. That's going to be, higher on the deficit, even if they're willing to cut spending. And on the Democratic side, maybe you have some higher taxes, but you might see some more spending. So either way, I don't necessarily think the deficit situation is going to get much better. And the other challenge with the deficit, I didn't point this out on the chart that I showed, but essentially, half of the increase in the deficit is coming from interest payments, and we can't really control that. That's just a result of higher rates, unless, again, we're spending less. And we've sort of had a lot of lifestyle creep during the 10 or 15 years when rates were at zero, when it didn't really matter, frankly, if we added to the deficit. But now it's really starting to matter as that's becoming more and more expensive. So unfortunately, higher taxes, less spending, relatively politically untenable. And that's why I don't necessarily see things getting much better. And even with spending cuts, if you referred back to the other slide I showed, if you look at the spending, so much of that is stuff that's somewhat untouchable when we think about Medicare, Medicaid, Social Security, defense, interest payments, that there's actually less to really dice away at than you'd think. And you can see that kind of stack of spending all the way on the left. And then on the right, that top right, that blue section there is the interest payments as a share of the deficit.
Yeah, the easy path seems to always be kick the can. Mindy, swinging back to you, I had a question about gifting options. So what option of gifting would you say, or what options, plural, would allow a donor to keep the most control? Can you talk maybe at a high level about certain methods of gifting that allow more rather than less control to be retained by the donor?
There are a couple of techniques that do come to mind. There are irrevocable trusts called spousal lifetime access trusts. They're not without their disadvantages, but it's a way of accelerating your lifetime estate tax credit as a gift to a trust of which your spouse is the primary beneficiary and your children or other descendants are the secondary beneficiaries. Another technique that in the right situation can be very successful is selling a business or a large asset to an intentionally defective grantor trust. That allows a continued income stream. A lot of times when you're irrevocably gifting assets, the problem is you're losing the access to the income or the asset. And if you sell the asset to a defective trust, which is actually a good thing, I'm not trying to sell you a bad thing. It's defective for income tax purposes, and you can still retain the income stream through the sale, the installment sale. And utilizing a grantor trust, we maintain the provision that allows you to substitute assets. So if you really needed the asset that you gifted back, we have sort of a backdoor mechanism to be able to access that. It's not without complications, and they're very, they're very specific to certain scenarios, but those are the two that come to mind.
Okay, that's helpful. I think we're just a couple minutes past time here, so I've got a couple more questions which I don't think we'll be able to get to. If you all have questions about Apereo's solutions, direct those to your advisor or to me, frankly. If you have any more detailed sort of estate planning questions, you can direct those also to your advisor or me. And we'll, some of these are more detailed, so we'll just have to punt and answer them on a one-off basis. However, I do want to thank our presenters today. Ellen and Matt from Apereo, Mindy, Kelly, Pete from Spencer Fain, and Mera from JP. Thank you so much for making the time to chat today. I think we covered a lot of good ground. Hopefully, to our attendees, you appreciated this, you learned something. And if there's anything we can help out with, feel free to reach out to your advisor, and we'll be doing our best to help you work through some of these complexities. With that, I think we'll wrap it up. So thanks, everybody. Have a nice holiday on Monday and be well. Have a good one.
Thanks. Thanks, everybody.